Everyone, this is day 2 of DAC, and we start off the Pavilion as we've done for the last couple of years with a financial analysis of where we are, what the folks think we're doing and why we're doing it that way. I have the joy of having Jay with me here. He's been following design space for 30 years. Everything from, of course, chip design software, but also how do people design mechanical systems and complete anything technology that has design involved with it. He's been following it, and also looking at a lot of the hardware companies over the years. And I think we all look forward to hearing some of his insights on what's been happening up till now, and maybe some trend lines on where it's all going. Thank you, Jay.
Great. Thank you, Matt. Good morning, everyone. So let me take just a moment to explain my role. And that is, as a Wall Street analyst, I'm one of those people that you hear on the quarterly conference calls asking questions, if you happen to listen to those calls. But more importantly than that, the role that I play and other analysts play is to assess a variety of attributes of a company's business, of an industry, and those various attributes would include qualitative considerations, such as a company's product portfolio, management, operational execution, addressable markets, growth prospects, competitive dynamics, and quantitative, which is going to be the subject of the presentation in a moment, where we look at empirical data in terms of revenue growth, profitability, cash flow, market share, those sorts of empirical data that ultimately go into an investment recommendation, which is a big part of the role that we play. It's not just understanding a company and the industry, but also we provide a service to our investors, who are professional money managers and institutions, to help them guide their portfolios, at least with respect to software. And so, again, the talk today will be largely empirical. If we have time at the end, happy to take a few questions. And so this is my firm. We're an investment research and banking firm based in New York. Let me start with this, which is a few topical themes regarding the industry. I've been saying in my research reports and in other public appearances like this, when asked for a broader view of what's going on in tech, not just in EDA certainly, that there are two arms races going on. Not wholly new, but certainly intensified. And one of those has to do with software development. I think a good example of that recently, a very large example, was the acquisition by Microsoft of GitHub. We see other examples, particularly in M&A, of companies adding to their portfolios in ways that have to do with software development. Adobe, for example, a company that I've been following for a long time as well, has recently made an acquisition that serves, in part, that purpose of building out their developer community. For the purpose of today, the other arms race, as we see it, is the intensified race around silicon development. One of the most interesting developments, I think, in this industry, particularly for the EDA companies and their evolving customer base, is Microsoft, for example, and other companies in the so-called systems area that are not semiconductor companies. Companies like Microsoft, Amazon, Google, and others have become clearly increasingly devoted to silicon development and have become, therefore, increasingly important to the companies represented here, the EDA vendors. I was at the Microsoft Developers Conference last month in Seattle, and it was fascinating to hear how much of the presentations, the sessions, were about various types of silicon development and Microsoft's investments in those areas. So all of that, I think, is a positive for the EDA industry. We have taken a fundamentally positive stance on the industry. I'm not here to give investment advice, of course, but I will note that we have been positive on the EDA industry as an area of investment for our clientele for the last half dozen years. Cadence's shares have quadrupled, for example, in that period. Synopsys has more than tripled. So clearly there's a recognition in the public markets of the increasing value of these kinds of companies as critical suppliers of technology to the aforementioned arms race in silicon. We see this in the growth statistics for EDA. Based on numbers from what used to be called the EDA Consortium, EDAC, which is a lot easier to say than ESDA, the industry grew at a high single-digit rate last year, crossing a $7 billion mark. We're expecting it to grow at a minimum of 4% this year. Perhaps it'll turn out to be a conservative estimate, but mid-single digits, I think, is a reasonable growth rate to expect for EDA. It so happens that last year was above that range, in part driven by upside in hardware-based verification or emulation. So that was part of the upside in last year's numbers. Importantly as well, the profitability of EDA has been improving. That may not be a focus of the audience here necessarily, but I think it's crucial because certainly it's important to the valuation of the companies, but for your purposes, profitability of these companies is essential to their ability to fund R&D, which matters a great deal to the future of the industry. EDA is inherently an R&D intensive industry, and when we see that the combined profitability of Cadence and Synopsys, which of course is a reflection of prior investments and the growth of the market, allows them then to reinvest in the business and keep that wheel going in terms of reinvesting back in crucial areas of technology. And as you can see, we expect that the profit margins of the companies are going to continue to increase, which again, something that investors like myself like to see. So this is the track of EDA for the last more than decade. Again, based on the EDAC numbers, TTM stands for trailing 12 months. I think this is far more representative than looking at things on solely a quarterly basis. And so you can see where that dip is. That was the recession now a decade ago. EDA was certainly excuse me, adversely affected by that in terms of macroeconomic conditions, in addition to which at the time Cadence was going through, as you may recall, a rather substantial business model and management change, which also adversely affected the results for them and therefore for the industry. But since then, clearly, the industry has been recovering, as you can see from the growth here, and we would expect that to continue. Here you can see a plot for EDA by region. 4 regions, the Americas, EMEA, Japan, and Asia-Pac. And clearly one of the most interesting phenomena over the last decade or more has been the rise of non-Japan Asia as an EDA market, where in fact in the last number of years Asia has been more than Europe and Japan combined. And so that is clearly a crucial market for the EDA companies, and we can certainly see this in terms of the investments that they're making in terms of R&D and sales in that part of the world. And of course, Americas are the largest market, but the growth of Asia, including for IP, by the way, not just core EDA, has been one of the most important phenomena in the industry over the last decade. Here we show something that we've published in our reports every quarter. This is a compilation of the EDA product categories, of which there are several dozen that are reported by EDAC. And what we do to gauge where the industry is growing is look at the individual product categories. One of the frameworks that we've been using to gauge the industry, or more specifically the companies, is a long-time thesis that I've propounded that I call product mix matters. What that means is out of the several dozen categories of EDA software, there are at any given time a small number, typically fewer than 10, that are growing at or above the overall industry growth rate. And there's a certain amount of predictability to those categories. We can work backwards from the technology requirements from the customers, work backwards to what the tool categories are that are going to be essential to meeting new design requirements. And so what you see here is a list of those categories like custom, ESL, implementation, and so forth, that have had the longest run of consecutive periods of growth on a trailing 12-month basis. And so each of the vendors has certainly benefited from these trends, Cadence and custom, obviously, Cadence and Synopsys in implementation, and so forth. One category that had been quite flat for the longest time that has recently picked up in the data that I think is quite interesting is synthesis. And so a large category, but the data showed for many years that it simply wasn't growing. And in the last year, or maybe 2 years, there has been a somewhat predictable positive inflection in the growth of that particular category, which certainly works to the benefit of Synopsys as the leading provider of that particular class of technology. And so this is something that helps inform our thinking about revenue growth for the vendors, relative market share, and the underlying performance of the industry. This shows the data through 2016 combining Cadence, Mentor, and Synopsys. The last publicly available data for Mentor was in 2016, their fiscal 17. We have a sense of how they did last year, post the Siemens acquisition, which was actually, according to management, quite good, but we don't have precise quarterly data to back that up. But in any case, here you see how the industry performed through 2016 for the big three, as we call it, and now we have just the big two. And here, a similar plot, which includes our forecast through 2020. These are based on our published estimates for Cadence and Synopsys, and you'll see that the line is generally moving up and to the right, profitability as well, and so this is a fairly steadily growing industry, and here we see also some data that we've recently published. We track EDA as a percentage of semiconductor R&D. And so semi-R&D is the bulk of the source of revenue for EDA, but clearly there's a growing category of the so-called systems customers. That data, frankly, is harder to get in terms of putting it into the denominator of EDA proportionality. In any case here, however, we see that EDA has been generally stable to improving as a percentage of total semi-R&D, and our methodology is based on a compilation of about 30 semiconductor companies. When I started compiling this data about a dozen years or so ago, we had over 45 companies, but now, of course, with consolidation, we're compiling data on just about 30 companies. And some of these spikes, by the way, that you'll see, that typically has to do with revenue effects for certain products or companies. So, for example, when Mentor has a very large quarter for Caliber or for PCB, given their revenue model, you'll tend to see a little bit of a spike like that. Same for hardware. But generally, it's a fairly smooth line in the last few years, flat to up as far as EDA is concerned, and as you can see here. And so there was a downward trend, and now clearly EDA has been increasing as a proportion of total semi-R&D. And then here is semi-R&D itself. At DAC 3 years ago, when there was a wave of consolidation that was then just beginning to be announced, there was certainly at the time a good deal of apprehension among EDA management as to what that would mean for them, based on the history of when there had been prior consolidations in, let's say, the early 2000s. And so I recall quite clearly 3 years ago, the management of all the principal public companies were quite concerned that when their principal customers, or some of them, were going to combine, in the nature of EDA budget math, 1 + 1 was going to equal 1.8 or less. And so they were very concerned about that post the mergers. It so happens that the effects turned out to be not nearly as adverse, or even adverse at all, as they had presumed would be the case. At the end of 2015, we published some research that calculated what the pre-merger EDA budgets was for the companies involved in the mergers, and we did a risk analysis that ultimately showed that in almost a worst-case scenario, the impact from post-merger cutting, if there were to be cutting, from the merging companies would be actually quite small percentage of EDA. And that turned out to be right. And so it turns out that the EDA bookings continue to perform quite well. You know, some very brief slowdown, you might say, but clearly that was temporary. And as you can see here, again on a trailing 12 basis, which is the most indicative, the semi-R&D spending has clearly been recovering. And we draw a distinction here between Intel and non-Intel because the bulk of the merging obviously occurred among non-Intel companies with the exception of Intel's acquisition of Altera. That's where we did see some brief slowdown in R&D, but it was brief only, and then clearly has begun to recover, and we see that now in improving spend for EDA. So here I'm going to give some examples of R&D by company. Start with Intel because they're the biggest spender. Based on our database, Intel accounts for approximately a third of the total R&D spending that we can compile. Maybe hard to see the print there, but what we show, based on some other published work that we've done, is that commercial EDA spending accounts for about 5% of Intel's total R&D. And in turn, that number, by the way, was approximately $650 million that we calculate last year for Intel's commercial EDA spending for people here. And that, in turn, accounted for a high single-digit percentage of the entire EDA industry. So it's pretty significant spend, obviously. Here we show two friendly competitors, Broadcom and Qualcomm, what their R&D tracks have looked like recently. And then two more friendly competitors, AMD and NVIDIA. And so you can see that AMD's spend has begun to recover some. NVIDIA clearly has overtaken it and has moved up and to the right at a pretty significant rate. So again, all of this creates a tailwind for EDA. This one goes back to my earlier point about the profitability of EDA being, I think, quite important, and it's certainly important to the valuation of the stocks, and again, their ability to reinvest in the business and drive cash flow. Here you see a comparison of Cadence and Synopsys. That deep V on the left there for Cadence, that was the unfortunate mishap from a decade ago from which they have materially recovered. And as you can see, they have now become, and we expect them to remain through 2020, a higher margin company than Synopsys, albeit both are clearly high profit companies. This is book to bill. Again, projected for the big two through 2020. For those of you familiar with Synopsys's business mix, 4 years ago they got into what they now call software integrity, which is largely a non-EDA business. What we have done is extract that from these calculations. So these book-to-bill numbers are solely core EDA, and we've extracted that other part of the business, which is a good business. It's growing very nicely, generating some good bookings, but we calculate that separately from EDA. And so here you see the plot of the big two, which together are over 2/3 of the EDA industry. And as you can see, the growth, as you can see from the red trend line, suggests about a mid-single-digit implied growth rate for the industry, as we discussed earlier. These are the dollar amounts of bookings. Again, the spikes, that's Intel. When they do their Synopsys renewals, and then we also show the plot moving up and to the right. This is on a combined basis, and the one line is revenue, the other is bookings. Obviously, the bookings are a little bit more volatile, but it drives the orange line, which is revenue. And here again, similar plot, we're showing our expectations for book-to-bill through 2020, basically connoting a healthy industry for the big two. Important for this crowd, R&D spending, which we've mentioned a couple of times. Here you see how the big two apportion their R&D spending in dollars, and proportion of revenue is obviously a very high proportion of revenue. This is always going to be an R&D intensive industry, and so this is clearly what we see here conveyed in this chart. This one is, again, going back to when Mentor had publicly available data. We're showing a multi-year plot of bookings share on a trailing 12 basis. Obviously, there's all sorts of things that go into this: contract renewals, market share dynamics, product renewals, acquisitions. So all sorts of things go into this calculation. But generally, you see Synopsys number 1, Cadence number 2, Mentor number 3. That's through 2016. Probably the same last year as well. Here we show by company. So Ansys happens to disclose their bookings by end market on a trailing 12 basis, or at least they give us a percentage. We can convert that to dollars. And in here you see the plot for their semiconductor and electronics business units. So again, generally doing quite well. The volatility also in their case has to do with timing of contract renewals. So for example, 6 quarters ago when they did their big Samsung and Intel renewals, you'll see some jump in the numbers. But clearly Ansys, which we have deemed the 4th largest EDA company, by the way, at about 3.5–4% share of the industry, is doing quite well, as you can see from the bookings data. This is just Cadence by segment. So you can see how they're doing on a trailing 12 basis. So this captures implementation, synthesis, hardware, custom, of course, and IP. Most categories generally up and to the right, with the volatility mostly around IP and hardware, as you might expect. Now, Cadence's book-to-bill has generally been higher than Synopsys's over the last number of years, which in effect means, over a long enough period of time, share gain. And their backlog has been growing at a faster rate over the last number of years, which again connotes share gain. Synopsys bookings grew last year, and their backlog grew by more than we had forecasted. But again, over a period of time, we've calculated and expect that through 2020, Cadence's book-to-bill could remain more positively over 1 than Synopsys's, but both will grow. This is just a little historical picture of Mentor through 2016, their fiscal 17. You can see how the bookings varied for things like Caliber and PCB over time. Unfortunately, don't have this precise data any longer, but it just shows you an interesting, almost decades worth of history of their business. And with Caliber obviously remaining by far number 1 in physical verification, and PCB they're number 1 as well. This quick snapshot of Synopsys. Again, expect good growth through 2020. This captures their whole business. I'm not excluding their software integrity business here. So this is not purely EDA, but at a corporate level, we expect them to continue to grow very well. Synopsys book-to-bill, as you can compare this to the chart I showed earlier on Cadence. And again, those rather spiky periods there, that's Intel. This is Intel. And so this is based on publicly available data. So we know that, for example, in 2016, Intel accounted for almost 16% of Synopsys revenues. It's almost a unique situation in the industry, that proportional relationship. And then in fiscal 17 for Synopsys, Intel grew to almost 18% of Synopsys revenues. Most other large customers, for Cadence and others, typically at most would be in the mid-single-digit percentage of revenue, like Apple and others. But here, this is obviously a long-standing and unique situation in the industry. In 2015, again, based on public data that we could back into, Intel spend with Synopsys was about $285 million, up $100 million in fiscal 16, up another $100 million in fiscal 17. So that's an enormous increase in the space of 2 years, much of that driven by hardware, plus some growth in core EDA, of course. But clearly, this is an immensely important relationship to Synopsys. But I will say that I think one of the undertold stories of the industry, at least as I've communicated to our investors, is that Cadence's position at Intel has seemingly improved as well. So that's important for them. This is, again, trailing 12 look at the Intel spend. I don't forecast this. This is just based on empirical data, but obviously important. And then coming to the end, One thing that we do in looking at all of our companies, not just EDA, but all the other engineering and technical software companies, I also happen to follow Adobe, about a quarter century now, and Microsoft at the enterprise software level. One of the proprietary things that we do to inform the research is we look in detail at the job openings that each of the companies posts on their websites. Anyone could do this, but we just happen to have been doing it now for half a dozen years and compile lots and lots of data in terms of openings by sales, by R&D, by geo, by product name, you name it. And we compiled all this data, plotted out, and the thesis is that looking at this data over time can have some coincidental or even leading indicative value. It can tell you over time that a company is looking to grow its sales force in Asia, for example, or a couple of years ago we detected that Synopsys was significantly ramping up the job openings for DC, which I thought was really interesting. And we see similar kinds of data for other companies, again, not just in EDA. I won't name it the company, but a few years ago we picked up a very sharp fall off in one company's job openings, and 3 weeks later they announced a layoff. So we just got lucky with the timing of that. But it turns out that there is, again, I think some predictive value here to when companies are opening up the spigot of hiring. And so this is data that we published last month, and as you can see, there's a pretty significant upturn here in job openings, particularly Synopsys, not just in EDA, but particularly as well for their new software integrity business, which is a strategic priority for the company. Not shown here, but one thing that we have also detected over quite a number of years now is Synopsys has an unusually large number of openings, typically on an ongoing basis in places like India, to some extent China, Europe has often been, for them and for Mentor, an area of substantial recruitment. A number of years ago, actually starting in the early mid-2000s, Armenia became kind of a hotbed of EDA development post-Monterey. And so we see a lot of these kinds of trends vis-a-vis hiring and where people are working in the data. One thing that has always been true as far as this kind of data is concerned for EDA is the small number of openings for sales. So I've often said to investors that the loneliest thing to be in the world is an unemployed EDA salesman because really just not that many openings. But if you're an engineer, you're in luck, as we can clearly see from the data. And again, the fact that the data are turning up like this, I think, is a positive sign because companies are simply not going to, increase their hiring rates above the normal attrition rates, which is what this data suggests, unless they're feeling good about prospects for the business, the need to reinvest in the business, whether it's by geography or product or business segment, or they've acquired certain companies, again, as in the case of Synopsys with their SIG business, or in the case of Synopsys and Cadence with respect to IP. This I take, and we've said as much in reports, as a positive indicator of where the industry is going, the company's clear willingness to invest and ramp up, which is ultimately important for the semiconductor and systems customers that rely on Cadence and Synopsys and its peers. I should mention ANSYS also especially in the aforementioned arms race for silicon development. So that's our quick view. This is a very condensed version of the investor presentation that I typically give, but in the interest of time, I just wanted to condense it, try to get across some key thoughts on the state of the industry, the prospects for the industry, which again I think are quite promising. And it's a matter of public record that while I'm not here to give investment advice at all, we have published ongoing positive recommendations for Cadence and Synopsys, and similarly for their peers elsewhere in engineering software, which is another important growing category that is going to become increasingly intersected with EDA. That's the meaning of the Siemens Mentor acquisition. That's the meaning of certain acquisitions by ANSYS as well. These two worlds are increasingly coming together, and we see this particularly through M&A. So that's the short view, and I'm happy to take any quick questions. There you go.
Thanks, Jay. You mentioned that you're including IP revenue in all of the things that you're giving for the big EDA companies, but you didn't really talk about how IP is doing as opposed to EDA tools and what's happening with the other IP companies. Could you elaborate there?
That's fair. Well, again, we're relying on EDAC data. I mean, it's to date the best, if not only, source for this, and it's a fair question because IP has in fact been growing more quickly than core EDA. We can certainly see this in Synopsys' numbers. Now, they do this thing where they combine three wholly unrelated businesses in a reporting segment: IP, FPGA prototyping, which is HAPS, and software integrity. Clearly, IP is the biggest piece of that. And so we have been able to reverse engineer those three components. And clearly, IP is the biggest and has been a big growth driver for Synopsys for the last many years. IP has resumed growth for Cadence, albeit on a smaller basis. It has resumed growth. And so IP has been a particularly important component of Synopsys' share gain in Asia, because Asia is now the second largest market for IP, surpassing Europe and Japan, second only to the United States. So again, good point. IP has clearly been an important contributor, as is evident in the data, to the growth of revenues for the EDA companies.
Do you have any insights on the non-big three companies? Because I look around with all the consolidations, it seems like there's a lot less smaller companies. Is it due to some of it is maybe lack of good ideas coming up or lack of fundings for new ideas to be tried with startups and things like that?
Right. Well, it's an interesting issue because the top three companies have grown to over 85% of EDA. If you go back only a decade, the top three, Cadence, Mentor, Synopsys, were about 75% of the industry, give or take a couple of points depending on the period. That growth from mid-70s to mid-80s has been a combination of organic growth and inorganic growth. It's just the cumulative effect of all the acquisitions that have occurred in recent years, Magma and so forth. And then you add in ANSYS, the top four companies are close to 90% of the industry. The other 10%, which is not an inconsequential number, it's over $600 million a year, is itself concentrated. The other 10% consists mostly of a small number of companies. That would be Altium, Zuken, and Keysight, and then lots of other small companies. And so at this point, the big EDA companies are not really going to be buying in that non-big three category for revenue addition purposes, with the exception of the larger companies. Should they be interested, they would be doing classical technology filler kinds of acquisitions. And so I won't say that there's no good ideas or anything like that. I wouldn't say anything of that kind. That'd be far too disparaging and probably not true. But clearly the EDA companies, certainly Cadence, have become increasingly focused on internal development. This has clearly been a story at Cadence. What we are seeing is more of an interest in adding to businesses outside of core EDA. That's the message of Synopsys' SIG acquisition, for example, and subsequent acquisitions since 2014. There have been no EDA IPOs since the early 2000s. There was that brief window, late 90s, early 2000s. Magma came public. They had their golden age for a few years. And then things kind of ran their course. In that period, late 90s, early 2000s, I was working on a number of IPOs in the pipeline that ended up never happening. The companies were too small, they weren't ready for prime time, small p. And so, it's been a long time since there's been IPO activity in this category. However, based on the tailwind that we see in the EDA, maybe there'll be some additional renewed investment in this category, but I'm not going to predict, by whom or how much or anything of that kind. But, the tailwind is there, so maybe there'll be some investments. The only caveat being, however, there are many very small categories categories of EDA, a few big categories in terms of software revenue, and those are already dominated by the big vendors. And investors aren't going to be particularly interested in a company that does really, really well in a small category unless they're acquisition bait. So we'll see.
Hi, can you comment a little bit about the current Trump administration's potential trade war impacting on the EDA industry?
Yeah, that's a very difficult question to answer right now. I get it more, as you can imagine, the last number of weeks. Now, EDA companies themselves, of course, are not directly involved in the manufacture of products. They don't get paid, with the exception of IP, on physical goods. So the concern would be, of course, if the health of their customers were to be adversely affected, if the transfer of IP were to be impeded. And so these are all possibilities that I can't factor in right now in the sense that I have no definitive conclusion. These are all risks, and so hopefully it will pass. But again, all I can do is identify the direct or indirect risk. The indirect risk is that the health of the customers would be adversely affected enough that they would pull back on spending. But also keep in mind, it would take a while to see that because EDA is predominantly tied to multi-year contracts. The spending is largely locked in place. The variability, is tied to IP, which is inherently lumpy, and to something like hardware-based verification, which again is by definition a lumpy business tied to CapEx. And so, it would be hard to ultimately separate the inherent volatility of something like that versus what the incremental adverse effect of a trade war might be, if there is a trade war, and hopefully it doesn't get to that. No other contestants? No? Okay, great. Thanks, everyone.